Good afternoon, everyone, and thank you for joining us for this Fidelity Meet the Manager session. And I hope you've enjoyed this morning at the conference. Joining me today from Singapore is Anthony Srom, who's the portfolio manager of the Fidelity Asia Fund, concentrated 20 to 35 stock portfolio investing across the Asian region. Now, you will see a Q&A box at the bottom of your screen, so please feel free to send some questions through and we'll endeavour to get to those during the next 30 minutes. We have a lot to get through, so without any further delay, I'll jump into the first question, Anthony. Let's start with US and China relations. What does this look like under the Biden presidency, and what does this mean for global trade and geopolitics?
Yeah, it's a pretty broad question, but I'll try best to tackle it. The way I think about it is very much a continuation of what we've seen under the Trump presidency. I think thus far there's been kind of no sign of the Biden administration kind of, taking their foot off the pedal, so to speak. You seem like a little bit of relaxation on some restrictions on securities up here, Xiaomi in particular, but by and large, the entity list or the Chinese military linked company list hasn't really altered. So what does it look like? Again, I think it's pretty clear long-term strategic competition between the two. The way I perceive it is that could have some other knock-on effects, which we may talk about later. But one thing in the back of my mind is a big X factor for the market up here could be what happens with Taiwan. But I don't think that would be anything imminent. But again, probably a huge X factor if something happened with that particular area of the region.
And is any conflict likely in that region? How do you assess as you say, it's a small risk, but it is a legitimate risk?
Yeah, well, there's a bit of saber rattling going on, and the key thing for the global economy is, you've got a lot of foundry capacity and IT expertise in Taiwan, so it could be quite damaging. Internally, we had a meeting with an ex-CIA operative, and I kind of pitched a similar question, and basically the reply was China and the US, it's almost mutually assured destruction if they went head-to-head at this particular juncture. So, we'll wait and see. But I think, again, from a market perspective, huge knee-jerk if something did go wrong or there was miscommunication geopolitically. But in terms of an outright war, I think very, very low chances in the back of my mind.
And what about your views on currency, the US dollar versus renminbi?
Yeah, so in terms of renminbi, US dollar, my view has been for a little while that renminbi is too strong. I think that's indicative of low liquidity growth in China. It's constraining GDP growth. And at some particular point in time, it's more likely than not that you'll see it devaluing. Is it going to happen imminently? Well, we've started to hear noises out of the PBOC that the renminbi may be a little bit too strong. But then in the context of what that means, if it does devalue, the flip side of that is a strong dollar, which I think has got implications for EMs and commodities in general, which is kind of, I think, where people have been positioned more so than not particularly commodities. So I'm of the view that the renminbi is too strong and it's constraining growth in China.
Okay, thank you. India is in your investment universe, clearly suffering a COVID crisis at present. How are you assessing the impact on the economy in India, both short term and more medium term, and also any impact on your ability to find stock ideas in that market?
Yeah, I think the issue with India has been there's a big divergence in valuations of companies that you'd like to own and the rest of the market, and that hasn't closed for a very long period of time. So the fund has just got one Indian company in it at the moment, HDFC Bank. In terms of the economy versus the stock market, clear disconnect. We saw what happened with COVID, second wave, massive spikes, kind of initial sell-off by the market, but totally look through it. And I think it's at record highs in the last week or so. So again, nothing's kind of changed from the portfolio perspective. But you continue to look, but nothing interesting right now in India. I think it's just a bit too expensive.
Yeah. Okay, let's stay with macro just a little bit longer. Obviously, inflation, very hot topic right now. Investors really assessing their views on inflation. What are your views, and should investors be concerned about potential inflation?
I think it's a definite concern. In terms of my view, I think the market seems to be thinking it's going to head in one way or potentially the other in a either gradual or transitory fashion. My view would be something slightly different in terms of be careful of the volatility of inflation. There's a lot of debt out there. If velocity doesn't pick up, you can get back into a kind of deflationary spiral. If you get outright monetization of fiscal deficits, that can lead to a rapid increase in inflation. So I think what I'm saying to you is the way the world's been going the last decade, and where debt is and government's propensity to spend, the volatility of inflation is probably a bit more important than directional. So the way the portfolio is at the moment, I'm kind of erring on the side that you're more likely than not to get an inflationary pickup. And in terms of the exposures, there's gold in the portfolio. But again, looking at more capital light businesses that have got reasonable prospects of some pricing power, i.e. push through of costs or get a bit of CPI plus inflation. So in the back of my mind, when I'm looking at companies, from an inflationary perspective, there's some of the considerations.
And I've heard you mention in the past sort of Alibaba as one of those names, which may not be people's first thought when they think about inflation, but maybe can you just expand on that idea a little bit further?
Yeah, so in terms of why is it in the portfolio, it's not entirely because of that, but just to run you through the rationale. We saw pretty earlier this year, later last year, when the vaccine announcements came out, market became very pro-cyclical, believing more of an inflationary bounce. There's a rush towards value stocks, commodity stocks. I think that was kind of the first reaction. Sometimes the first reaction, I don't think it's the correct reaction. Particularly if you look at what happened in the 1970s and inflation, and BHP and Rio Tinto were listed back then, but Rio Tinto was called CRA. So I kind of would be a bit more cautious on material stocks, given the way they played out in a high inflationary environment. So that brings me on to things like Alibaba and capital light businesses. When you've got inflation, you don't want to be having to tip in truckloads of capital with not much prospect of real pricing power. That's the thing you've got to distinguish, not nominal pricing power, but real pricing power. So when I look at things like Alibaba or Tencent or these internet names, negative working capital, capex light, the capex that they do, you might consider M&A as part of capex, but that's something that could be switched off relatively quickly. Good margin, good growth, still under monetized. I think you've got better prospect of getting outperforming security from those kind of features than something that's capex hungry with not much pricing power.
Yeah. Okay. You mentioned gold as well, Anthony. I know the fund does hold Shandong Gold in China. Are you currently comfortable with that exposure, or are you potentially considering looking to broaden your gold exposure at the moment?
Comfortable with the exposure at the moment. It's been a bit testing the last 6 to 9 months. I think part of that has been the rally that we saw in these cryptocurrencies. I'm not that positively disposed to cryptos. So looking at Shandong Gold, yes, it's still in the portfolio. Still happy with it. Gold seems to be getting a bit of traction now. But again, when I think of the longer term setup, so the next 3 to 5 years for gold, has the thesis changed compared to 2 to 3 years ago? No, it hasn't. Again, it's just continued increase in debt to GDPs globally, continued increase of central bank meddling in the whole process. As we go back to what we said earlier, in terms of my view of putting more inflation than less, that leads you down the path of yield curve control, negative real rates, which I think is a good setup for gold. So the fund is still invested in it, and no real change to the thesis.
Okay, thank you. So the Fidelity fund does have the opportunity to buy A shares directly, and that has been a real positive for for clients in recent years. So how are you assessing that market at present, both on a sort of idea opportunities perspective, but also on valuations?
Yeah, so again, it's opportunistic. The fund has bought two companies of note this calendar year: Focus Media, circa 250 basis points, and Beijing Yuhong Oriental Waterproof Company, which is about 450 basis points. So was that 7% of the fund has gone into A shares, new ideas this calendar year. So what I tend to find with the A share market is from time to time you get huge swings in sentiment. We haven't seen anything of that of late. It's probably been one of the markets that's corrected a bit more than others in the region, but I wouldn't say suicidally negative sentiment, but it has thrown up some stock specific ideas. And the way I think about China is, again, very stock specific, but be mindful of the swings in sentiment that can happen both positive and negative, and be ready to try and take advantage of that. So at the moment, not much in the way of new ideas in China. Happy with what we've got. If anything, maybe looking at exiting some of the lower conviction positions in the portfolio.
Okay. Let's move on to a couple of stock names now. Taiwan Semiconductor and SK Hynix. There seems to be quite a supply-demand imbalance in the microchip market globally, so that seems like a pretty strong tailwind for those names. And I guess how do you see that playing out over the medium term as well?
Yeah, I think slightly different for both companies.
Mm-hmm.
I think SK Hynix, that's memory. TSMC is foundry, so they are kind of intertwined. But I think we're closer to the end of the cycle for memory than we are for foundry. You're right, supply demand continues to tighten, and the old saying, stronger for longer, seems to be playing out with memory. So in terms of TSMC versus SK Hynix, where we are today, I'd be more inclined to exit Hynix on strength. We probably see that cycle continuing on into next year and then possibly into 2023. But again, the market being a discounting mechanism, you've got to be kind of, well, in my mind, probably not try and hold on too long and get too greedy. TSMC is a bit more of a structural story in the sense that the foundry market continues to consolidate. We saw the issues that Intel had last August. To me, that led to a profound change in how you should think about the industry structure, the margin and return potential for something like TSMC. And again, on top of that, you've still got the mega trends of 5G, Internet of Things, autos, high performance compute, etc., which to a certain degree benefits Hynix as well. But I think TSMC is in a better longer term sweet spot structurally than Hynix. So just drawing that distinction between the two companies.
Okay. Alibaba was a name you mentioned already. So talking about Baba and I guess the tech names more broadly in China, we have seen some closer government oversight of those names, shall we say? So I guess, how do you see that regulatory / government risk for the tech sector in China?
You could say it could always get worse. There's no signs of that happening just yet, but what do I mean when I say that? In my experience, looking at some other Chinese companies, you've seen interference from the Communist Party in the sense of putting Communist Party government officials directly into the companies themselves, be it board or some sort of senior oversight role. We haven't seen talk of that in the tech space just yet. It's just been more kind of slap on the hand, fine, try and share some of your data with us. But it can always get a little bit worse. That's one example. What could be another example of a risk? Well, the government saying, sell us a golden share where we can have veto on anything we want. So there's still risks that are out there. How am I seeing things at the moment with tech? We're kind of washing through some of the regulatory issues, not out of the woods just yet. Certain companies are at probably, let's call it, a bit more advanced than others. Either Alibaba probably first in and closer to being first out from that respect than say Meituan and Dianping. But I think the issue the market's grappling with now is, probably too many platforms, not enough eyeballs, and you're seeing like reinvestment in product, margin hit, earnings downgrades, stock struggling to perform is something to be concerned about, okay, at the margin, but, are there some analogies out there, and how would I consider it? I mean, the client base today is Aussie. Look at what happened with Coles and Woolies, with Aldi and Lidl and the hard discounters. I mean, margins were too high for Woolies and Coles. They had to reinvest in product and price, took a margin hit, and yes, it took a couple of years, but Woolies has gone from what, $24, $25 to, I think last time I looked, north of 40, something like that. So that's the way I see the tech space now, kind of washing through regulatory, but there's still some headwinds.
Okay. Let's stay in China, a name that's been in the portfolio for a long time and has been a really, really strong contributor over many years is Kweichow Moutai, the revered Chinese spirit maker. I've never had the chance to try myself, unfortunately, but I mean, what makes Moutai a great business in your eyes?
Kind of what we discussed earlier with respect to inflation. The fund has had a position in it for a long period of time, I think since 2014. And again, when I was doing the analysis on that company with the analyst, one of the first things I looked at was kind of balance sheet strength pricing. And over decades, the pricing of Moutai has outpaced inflation, which is something that I think is very attractive. Again, capital light, a lot of intangibles, so think goodwill around the product, not having to spend capex. Still got solid growth, demographic tailwind. That's not the biggest position in the portfolio in the sense that it used to be 10% active. We're pretty closer to 7 today. And part of that reduction reflects a bit of a valuation re-rate that's happened over the years. So I still think relative to the market, it's an attractive place to be. And I've just kind of mentioned some of those attributes.
Yeah. And there's still opportunity for that company to take more of the margin on the supply chain as well?
Yeah, that's, I think, what the market's really keeping an eye on. They're doing two things. One is greater direct sales. So again, that's margin accretive, return accretive. The big one that a lot of people are waiting for is a ex-factory price increase of the product. So Moutai doesn't get the retail or wholesale price of the product. What they get is what they sell at the factory gate. That's, I think, 969 renminbi per bottle, and retail prices are somewhere around 3,500, 4,000 renminbi, depending on the time of the year. So I think at this particular juncture, you could call it the distribution channel is getting more value than Moutai, which is a rarity in the history of the company. So I think the setup is favourable. What's not working in their favour is this year's a kind of 100-year anniversary of the Communist Party. So no one wants to do anything controversial. So it's probably a next year issue.
Okay. China, we've spoken a lot about, and it is, clearly a very large part of your universe. Understanding you are, bottom-up investor, looking at company by company, but other parts of the region that are attractive at present that you're looking at closely?
Taiwan. That was a kind of a COVID scare similar to India, which was probably a few weeks ago now. The fund bought into MediaTek in that huge downdraft. I think the stock went from about 1,300 Taiwan dollars to about 820 at the low. So the fund got in at 800, not as much as I'd have liked, but that's a new addition. That market still hasn't re-rated or kind of knocked off any concerns around that, but it is a market that I'm looking at for ideas and does look interesting to myself. Philippines, but the problem is that it's not the most deepest liquid market in the region, so that's a risk overlay. And again, the market seems to have got relatively positive on that recently, and the fund didn't buy anything in the Philippines. It was on the radar, but kind of nothing lined up. But markets seems to have bounced away in the short term, so we'll see.
Okay, thank you. And at a sector level, portfolios underweight financials. Just keen to hear your thoughts on the reasons why that is.
Yeah, basically goes back to what we were talking about earlier, to a certain degree on yield curve control, but also government intervention. I think what COVID has brought to the fore is, governments can and will dictate where credit gets allocated. The question is, look, do you get your money back from that? And we saw some backs and guarantees during COVID. But again, I think government intervention is a negative to be aware of. Capping yield curves would be a negative in my mind. We saw the value to growth switch over the last 6 months, so valuations aren't as attractive as what they used to be. And I think what I'm trying to say to you is the risks are a bit more elevated and valuation's not really attractive enough to get involved.
Okay, yeah, that makes sense. Switching tack a little bit, sustainability, certainly topical and of increasing importance to our clients. So how do you think about ESG issues, both at a research level, working with the Fidelity analyst team, but also at an overall risk assessment side?
Yeah, so I think at the highest level, the way I think about ESG's a risk factor. You kind of don't want to wake up tomorrow morning and find out something's broadside at a company. My personal experience being in Asia, I think this will be the 15th year. Numerous times you see, let's back up the clock, 5-6 years ago, ESG really didn't exist per se. They were just either high quality companies or low quality companies. You tended to find blow-ups in the lower quality companies, which today would be kind of your lower rated ESG types. So to me, the way I think about it is if you're looking at research, you're interacting with the analyst and you see that the company's lower rated by our internal research, that kind of raises the risk parameter. You want to know why, try and explore it with the analyst. Are they trying to improve it? Are they ignoring it? Et cetera, et cetera. So for me, in a nutshell, ESG is a risk factor. And again, just mindful of the lower quality companies typically have had the bigger blow-ups. So you want to be mindful of those before you kind of invest. If you're going to invest, at least the reward's got to be there to justify the risk, you think.
Yeah, okay. I mentioned at the start, concentration of this portfolio is a big factor. You very much back your own judgments, holding somewhere between 20 and 35 stocks, and their performance that you've delivered has been very well received by our client base here in Australia. But what's also surprising to many groups is that the downside capture has been quite pleasing. So in down markets, the portfolio has held up very well. It's about 70% downside capture. So how do you think about portfolio composition, interest stock correlations, and risk, and why do you think that downside capture is so strong?
Yeah, so if I back up the truck a little bit, I think of risk at the security level. So risk to me is not beta, it's not volatility, it's not all these kind of things. To me, risk is things like bad management, levered balance sheet, bad product, bad government regulation, and the list can go on and on. So when I look at the companies that typically get included in the portfolio, they're lower beta, stronger balance sheet. I mean, look, if there's been a persistent factor exposure that the fund has had, it's quality via balance sheet strength. And again, if you think about what happens in markets, so now we kind of take it from the security level to the portfolio level. Your point on correlations, I'm mindful of the fund being concentrated, not doubling up on correlation. So when positions are being added to or entered into the portfolio, kind of make sure that they're not highly correlated with a bunch of other things in the portfolio, because you're not really then picking a stock, you're picking correlation, and it's something to be quite careful about. But if we go back to what I was saying earlier, the nature of the companies that kind of fit the process, when you go into a downdraft in markets, if there's a lower level of correlation to begin with straight away, that's kind of a second layer of buffer. So you've got relatively defensive companies, some of those characteristics I mentioned about, lower correlation. When you get a huge downdraft in the market, correlations tend to converge to one. In theory, you should converge to one from a lower starting point and hopefully pick up alpha in the process. And kind of what we've seen thus far is theory and practice kind of marrying up, which has been good.
Okay, thank you. A few minutes to go, so a couple more questions to get through. Clearly since March last year, it's been a very, very sharp, strong recovery and very positive market environment for investors. Valuations, how are you viewing valuations? I know part of your process, you're looking at fundamental sentiment and valuations, so that's a key part of what you're looking at. Is it harder presently to find appropriately valued stocks for you?
yeah, I think if we draw it to the recent past, and by recent past I mean April, May, I think it's been very quiet compared to the last few years. So low turnover, not much in the way of new ideas. As I mentioned, in China there was Focus Media, Beijing Oriental. In Korea, the fund bought Kakao, I think in January, February. So they're really the three of note this year. In terms of markets, yes, I think you're kind of paying the most for the least that you have for decades. And what I mean by that is valuations are elevated, margins have been continually compressing, returns have been compressing. So the rubber band's just getting stretched and stretched. So as an investor, what do I think about? When I look at a company, I think, how's it going to perform relative to the market? Because that's the way I think is relative outperformance. So I think where we are today with market valuations, the expected return is pretty muted. And again, as I mentioned, not much in the way of new ideas, happy with what we've got. But, it's a relatively quiet time right now.
Yep, makes sense. And just thinking about the last year, your inability to travel across Asia as you would normally, I mean, your interaction with companies and company management, maybe just worth touching on how that's gone over the last 12 months.
Yeah, it's I think it's gone pretty well. It was an initial, shock. What's Zoom and how's it all going to work? But it all worked out nicely thus far. It would be good to get back on the road, hopefully sooner rather than later, but I'm not too hopeful on that front. But yeah, in terms of analyst interactions, company meetings, it's been relatively seamless. There was that adjustment period, but I don't feel like I'm missing anything that I'd like to get. It'd be good to have a beer with a colleague in Australia or a cup of coffee with someone somewhere else. But other than that, in terms of the information flow, I'm pretty satisfied.
Yeah, good to hear. And final question from me today, I guess, greatest risks across the portfolio. You might have already touched on these, but is there one or two things that investors should be mindful of that you're watching particularly closely?
Yeah, I think we've kind of covered off on 3 or 4 of those, which would be Taiwan geopolitics, so getting caught up between the China and US stuff we spoke about earlier. I think that would be a huge X factor if something went wrong, at least in the short term, for the Asian region in particular. Renminbi devaluation, I don't think anyone's expecting that thing to get repegged by 10% tomorrow. I mean, we saw that happen a few years ago. It was August, I forget the year, but that was a huge shock to the market in the short term. And inflation and interest rates. Look, I mean, COVID is an obvious one to kind of point to, but we've seen thus far markets kind of brush through that and look through it. I'm not that concerned about COVID, but the prior 3 to 4 examples that I gave is something that could see a lot of churn in the market. Could be sector rotation, or could be just outright reassessment of risk versus return and then some downside.
Okay, well, thank you very much. We will leave it there. Thank you, Anthony, for your time today. Thank you, everyone, for joining us. The Fidelity Asia Fund is rated bronze by Morningstar. Anthony and the team have delivered really strong alpha for clients and really strong risk-adjusted returns over the last 7 years since Anthony's been in charge of this strategy. So if you have any follow-up questions, we will come back to you with those. But thank you again and enjoy the rest of your afternoon. Thanks, Anthony.
You're welcome. Thanks, Andrew.